when a big loss is a win. I want to share some trades with you, a trade with you this week. Of course, the power of the married put and the radioactive trading techniques in action. It was a tough week for earnings. I mean, today we saw XOM record-setting earnings of $19.6 billion, and they increased their dividend, I believe, to 3% or 3.1%. CVX Chevron, of course, also did well. Apple was up 8%, which was actually a bright light in the tech sector, considering the other day Meta was down almost 25% to go below $100 per share. I think it closed there as well. Amazon, a swing and a miss, it was down 7.5%. And we all saw Microsoft took about a 6.5% on weak guidance going forward. And another one you might not know about, a little known stock called LRN, Stride Incorporated, was down 30% with an earnings miss earlier this week as well. So why should we care about LRN? Well, LRN was a married put position that Ernie opened in the Fusion portfolio. Can we be long stock like this and still win? Well, here was the initial structure. On September 30th, Ernie bought 100 shares of LRN at $42.83. Following the rules in the blueprint for the proper married put structure, emphasizing the 3 core principles of proper position sizing, the at-the-money bell curve, and the time decay curve, the March 17th 44 put was purchased about 154 days out in time at the time for $6. So the total out-of-pocket investment for this position is $48.83. Purchasing that 44 put means that we're guaranteed to get 44 back even if the stock dropped to 0. So the maximum risk on the position is $483 or 9.9%, slightly higher than I like to go with the married puts that I post in the Fusion portfolio. But this is Ernie's trade. About 2 weeks into the position, on October 17th, Stride had moved up to 45.55. So it's up about 272, around 6.3% from where Ernie purchased the stock. That in-the-money 44 strike put, which when purchased at $6 had some intrinsic value and some time value, it's now out of the money. It's all time value, and it's still priced at $4.26. Yes, the initial time value of the risk was $4.83, so there's about a 60-cent drop there. But we're retaining most of the time value, even though the put is out of the money, because it was properly structured and it was out to March, following the rules in the blueprint. The put is a second working asset that can be manipulated in your favor. The married put is not just about putting on the stock and put position, hoping the stock reaches break even 150 days, 160 days out in time, and then just looking to sell calls. There are 4 income methods that utilize the put option to manipulate the trade, to either lower the initial at risk, lower the break even and the initial at risk, lower the break even, maybe slightly increase the risk, or to be able to profit in both directions. One of these is income method number 4. When the stock moves up above the put strike price, we'll look to take advantage of the ATM bell curve, and we're going to sell to close our now out of the money put and buy to open a higher strike put, as we would if we were just opening the proper married put on that day. What Ernie did after the stock had moved up on the 17th, he sold to close that March 44 put for $4.26 and bought the March 47 put at $5.75. Now this adds $1.49 to the cost basis, to the debit. The new total cost is now up to $50.32. But that price of $1.49 gives a $3 higher guaranteed exit. We're now guaranteed $47 back on this trade, so the risk dropped down from $3.32 or 6.6%. I'm sorry, the max risk dropped from $4.83 down to $3.32, or 6.6%. We've lowered the risk by 3.3% in just a matter of 15 to 17 days. Not too bad at all. It's a third of the risk essentially gone. A few days later, on October 20th, Stride continued to move up and went above $47 per share. Now, this is another opportunity to use income method number 4 again. The March 47 put was now at 510. Remember, he paid $575 originally for it when the stock had moved up to $45.55. Now he's selling it for $510. He only lost 60 cents on that position, and the stock has moved up another $1.50 from $45.50 to $47, gaining more on the stock than we lose on the put. But that $510 is all time premium. So we're able to sell out the time premium and move up again to the 50 strike put with the same expiration for a cost of $680. This was an increase of $1.70 extra net debit on the position for another guaranteed $3 higher payout, moving from 47 to 50, only cost $1.70. The new total cost, and yes, you could say the break even all the way out to March expiration, not right now, not at the time Ernie did the trade, but the actual break even if he continued to hold the position all the way to March expiration and made no adjustments, is $52.02. But we're guaranteed to get $50 back. So the new risk now is only $202 or 3.9%. In roughly 20 to 21 days, he was able to lower the total risk on the position by 6%. Okay, so we still have a risk of 3.9%, but what is going on here? Why would I ever increase the cost basis and increase the break even, adding a consistent debit to the position? Well, it's to get that higher insurance payout, which, as we saw, lowers the percentage at risk we have in the trade. We don't want to time the trades necessarily. We want to trade time. That's an old axiom from Kurt Frankenberg, who originally wrote the first form of the blueprint. But what you're looking at and seeing in action is one of the 3 core principles I mentioned, the at-the-money bell curve. And what the at-the-money bell curve shows us is that at any time you look at an option chain, the option closest to the stock price is going to have the highest time premium or extrinsic value of any of the options in that same cycle. Not the highest price. The deep in the money options are going to have the highest price, but that includes intrinsic and the lower time value. Related to the puts, if we go to an out of the money put, we have a much lower time value. Say here a 35 or a 37 put, we're going to have a much lower time value than what's right at, let's say, 43 strike. So when Ernie initially bought the 44 put, it was in the money for the proper single-digit risk protection. It had some intrinsic value to it, of course, only about $1.17 of that initial $6, but that risk of 483, that was the time value at the time. Now, as the stock moved up in price, went to 45.55, 44 put still had 426 of time value remaining, but it's all out of the money. The 47 put is on the other side of the ATM bell curve, and that's where the swap happened. We swapped time value over and across to guarantee ourselves a 3-point higher payout. In this case, only paying about that $1.45, $1.50 to get a 3-point higher payout. And as the stock continued to move up in price later on October 20th, when LRN was at just about 47.05, 47.10, the 47 put that was this amount of time premium swelled to the higher time premium. Now remember, when the stock was at 45.55, this 47 put was 5.75, if I'm not mistaken. That was when he bought the 47 put. Well, $1.50 of that was time premium. Okay, $1.45, right? I'm sorry, intrinsic value, $1.45 intrinsic value, which leaves us with only about, $4.30 or so. Let's just call it $4.30 to make the math easy, of time value, because it was in the money. When the stock moved up to 47.05, remember, he was able to sell to close this put at 5.10. Did he lose money on the put? Yes, but he gained more on the stock than he lost on the put. And as you can see, the time value went from 4.30 when he originally purchased the 47 up to 5.10. We're not timing the trades. We're trading the time. And that's the effect of the ATM bell curve in action. And that's one of the three core principles we use for all of the income methods, but how it really works with this income method number 4, one of the 13 ways really in the blueprint. But why focus on limiting risk? We started off with a relatively low risk trade guaranteed of only 6, 7, or 8%. Well, it's never a bad play to focus on limiting risk, even if it increases your cost basis with income method number 4 in these uncertain markets. As we saw, earnings were also coming up on around October 23rd, I think, or 24th. It was the 25th, my apologies, which means high implied volatility. Now, he already made this adjustment, but on the same day, looking out in time, which options are going to be most affected by the earnings? Well, that would be the November and the December series. So after Ernie rolled up with income method number 4 for the second time, cut the risk down to 3.9%, he decided to sell to open the 16th of December, pretty far out in time, about 45 days out, but it generated $233 in premium, which means now the new risk was 202 or 3.9%. With the premium in, the risk is down negative 31 cents. It's a bulletproof position going into earnings. And this is where the position stood. Even if the stock fell further down to $4 per share, $3 per share, $1 per share, still guaranteed a profit of 0.6% on the entire position. I could close it out really at any time. Now, if it went the other way, I usually don't prefer to use income method number 1 around earnings, but with the uncertainty, Ernie decided that he would rather be bulletproof on this position. Don't think he was expecting the stock to go up here, which would still have been a profit. He was expecting positive earnings, maybe up here at 50 or 51, and he could adjust that income method number 1, essentially that covered call inside the married put, the same way you might adjust in a covered call. Got the inflated premium up front to bulletproof the trade to cancel the risk on the position. So why focusing on limiting risk? Well, because of the uncertainty that we've been seeing in the market and the things that can happen and the things that did happen. As we saw, the earnings came out on 10/25. LRN dropped about 30% from 47, 47.80 almost down to $34 per share, 32 I think it bottomed out at one point. But the married put structure, the proper application of the income methods, had a small guaranteed profit, even with that 30% decline on the position. So can we really say the big loss is a win? Well, it's not a big win, but I'd much rather take the 0.6 or 0.3% positive guaranteed return. He could liquidate it now for that value. It's going to cost him a little bit to buy back the call. Put still has a lot of time value, or some time value, even though it's deep in the money. But it's a profit of 0.6, 0.3% on a stock that had a bad earnings surprise and fell 30% from its peak. Could covered calls have pulled in 25% in 30 days to cover most of that decline and that surprise? Not at all. You would have gotten maybe 5%. Maybe with inflated IV, you would have gotten 6%. That 50 strike call that Ernie sold when the stock was at 47, that's around 5%, isn't it? You got 233 for it. So it's around 5 or 6%. But you wouldn't have been able to generate 25 or 27% to mitigate the unexpected decline. You could have gone out of the money with a naked put, sold a 40 strike put for protection. Now you're buying it back for $7 or $8 because the stock's trading at $33, $34 per share. This emphasizes the importance of controlling risk in these uncertain markets and the benefit of the blueprint at RadioActiveTrading.com. Protect your stocks anytime, earnings or not. full structure on how to properly limit the risk and apply those 3 core principles I mentioned. Full details, when to use, and how to adjust the 13 different income methods. Chapters on combining income methods, which we saw with a 4 and a 1 combination, and full chapters on exiting the RPM, full appendixes, and more. But I wanted to review that example with you. Ernie wanted me to review that example with you and go through it, but it just illustrates again the importance of controlling risk. Why do we add a net debit with income method number 4? Because to lower the risk for uncertain markets, we're going to call this a win, long stock the entire time, even though the stock had a big loss.